If you've got a family trust and you've had that property for more than a year, the discount is actually determined by who receives the money. If it's a company beneficiary, so you could park the money in a PTY Ltd company or an investment company, or some people call them bucket companies. But I would say for most people, if you've been holding that asset more than a year, you're going to find that even the highest tax rate of 45 plus the 2% Medicare levy coming in next year, 47%.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
Hey Ash, thanks for joining us today. Really excited to have you on the show. And for all of our listeners, you'd know that we haven't actually touched on accounting or tax or anything in that 100-odd episodes. So excited to dive into it today.
Awesome. Thanks, Jared. I really appreciate you letting me speak to your listeners and hopefully give them some background around tax and property and guide them in a direction that might help them.
Well, before we dive in, give us a bit of background on you and how did you actually come to be an accountant? Because anyone that knows you probably wouldn't pick you as an accountant at first meeting.
Yeah. I think it probably picked me. So, you go through that high school phase and you're not sure what you're going to do. And it's pretty hard to ask a 16-year-old to work out what their direction in life is. Accounting was just something I was good at. It was easy. So I could have probably gone down a few other paths. And I think I started off doing a computer science and accounting degree when I went to uni. And I realized very quickly IT was, in terms of coding, was not my forte. And I like numbers. And then through that process, you go through, trying to find a job after you finish your uni degree and have a bit of fun. And the place I landed happened to be one of the boutique firms in Perth where I actually happened to work with high wealth clients around Perth and see their tax structures. And it was very fortunate. There was no planning or strategic mindset to get into that, but that's where I landed. And there was an interest there. I did deviate. So I think that's probably what you're alluding to. I actually went into a teaching degree and I found I wanted to teach and pass on knowledge, and that's sort of where I'm doing a little bit of both. So I find these podcasts as an avenue of some form of my teaching degree being used in education form. So really appreciate the opportunity to talk today.
Well, it's always good having an accountant that can actually tell you why things are done a certain way, and instead of just including it as a big black box that you hope the right things are going to come out from.
I'd hope that should be the case for most of us, but yes, I'd love to be that person for most people.
So tell us a bit about entities and structures and what's commonly used for property investment purposes.
Yeah, look, from a property investment purpose, I suppose there's the various structures that exist. Is some people just buy it in their own names. Some people buy it with the partner, so a partnership. Some people will use a trust, so a discretionary family trust is a structure that sometimes exists. Some people will use a unit trust. They're probably more used in a property development side of things. And on a rare occasion, we've probably seen a company used, but it's not a typical structure used for buying property for a few reasons, mainly around capital gains. Tax would be a disincentive to use a company.
And it can be a little confusing for some people, especially to hear all these words thrown around, because a trust also has a trustee, and that can be a company or an individual that's sort of controlling that trust too. So how would you start to unravel and explain?
Yeah, I suppose it's very valid. So a trust is an entity that is controlled by a trustee, and the trustee will make decisions on behalf of the beneficiary. So as you alluded to, in the eyes of the corporations law and in our court system, the only two people that can run a trust are either an individual, because they're recognised by law, or a company. So that's where a company can run the trust. And a lot of people will probably go through setting up a company for a few reasons. Probably the most common reason is around estate planning. So in case something happens, titles don't need to change because the title is actually in the name of the company, opposed to if it was in my name, for example, and I passed away, you have to wait for probate and everything else to run or to continue to use that property. So for a lot of estate reasons, that's one of the reasons. Sometimes entities are used for maybe land tax purposes and other things like that. So that's the most.
Go into some of those today.
Some of those things, yeah. So probably the best way I explain a trustee of a trust is it's the driver of the vehicle, and the trust is the vehicle. So it's who's driving it. Is it going to be a company or an individual? And your accountant or advisor will sit down with you and go through what the pros and cons are of that structure, I suppose.
Well, what are some of the main advantages of using entities? Because different things get thrown around online, and you get half truths and little things here and there. But again, none of this is financial advice, and obviously someone's situation is going to be very dependent as to whether that's an advantage for them or not. So where do we start to see why we might use some of these things?
I think you probably alluded to it. Everyone's circumstance is different, but I think it starts with the purpose of that property. So, you talk about, some people will talk about yield, some people talk about growth, or it's a combination of both. And then it's also looking at what their income tax rates are themselves or their partners, and to go through that process and then understand the purpose of the investment and then finding the tax structure that's probably most suitable for them. I think the biggest thing that's probably coming up in the next 12 months is, the tax rates are going to change come 1 July 2024 with effectively the middle tax bracket going. So someone that earns $45,000 to up to $200,000 is going to pay 30% plus the Medicare levies that apply to them in their tax rate. So then you'd come back to, well, if you're not in that top tax bracket, a partnership or an individual structure might be perfectly fine, given you don't need the trust because you're not going to hit that income threshold. And those are all the things you'd have to weigh up. And if number of properties, so then maybe land tax is an issue, or where the properties are. But all of those things are long-term, because obviously the other thing that we're probably not going to go into today is super, but there's other structures. So always come back to the purpose and then sit down with your advisors to find the right structure. And I've seen some doozies over my time, and I'm sure you have too, Jared. But I've had clients with multiple trusts with properties and all have losses in them, which haven't been the right structure at the start. But maybe they were the right at the initial purpose. But I would have assumed at some point during that person's property journey, at some point maybe multiple trusts didn't make sense if you kept having losses in it, and the negative gearing was trapped in the trust opposed to being used against your income as a salary and wage person. So again, I think that's where advisors need to be engaged, and ideally early in the piece so you get it right, because it's literally when you sign that O&A, that's when you should know what entity that structure is. So
I've had quite a few buyers over the years, make their offer and then come back later and say, oh, I've only just created the structure, can we put it on? And, it gets very messy, potential double stamp duty involved. And, these days things are a lot tougher with Landgate. Back in the day, there used to be able to have an and or nominee. This is going back God knows how long, 15, 20 years. And they wouldn't pick that up, and you could swap it out almost at any point during the settlement for another entity or another person even. And there was a lot more flexibility. But these days, you can do a substitution to add your partner on easy enough and just complete a simple form. But I think they look at changing to a different structure during that settlement process as not being okay.
Yeah, and especially given the move to the PEXA system and an online processing system, a lot of the settlement agents or settlement lawyers would have already processed a submission to Landgate. So yeah, it's very important, get the structure right. And it's a big purchase. Most people are spending hundreds of thousands or millions of dollars on property. It's not that hard to reach out to your advisor just to touch base before you fill out that offer and acceptance. So you've got to plan around it, especially if you're going down the property investing platform. So
And does the way that you earn your income have a bearing on whether trusts can be more, beneficial for you? Let's say take a PAYG. How does that compare to being a business owner, and how these might all work together?
So I suppose if you're a business owner, depending on the size of your business and the profit that you're potentially generating, you might already have trusts as part of your structure of setup. So it's probably already existing in there. So the cost of admin or accounting or processing already exists because it's already part of your normal cost.
Well, that's a good one to almost take a little pause on, because people set up these grand structures that are, large, and they don't think about the ongoing cost of accounting and, the actual upkeep and paperwork and all the background that goes into maintaining these things. So, a valid point.
I think it gets people caught out a lot, and we try to, not that I want to do less work, but we try to really drill down with clients on the need of the trust, because it's just as much of a pain for us at the end trying to close it down if it's not the right vehicle. And the last thing you want is like the example I spoke before, where a client just got caught up with a whole bunch of losses in 3 or 4 trusts, and it took multiple years before those losses were used up, and that was clearly not the right structure. But the accounting fees were charged and had to be charged because we had to still do the work. So it was just a mess of a previous advisor that created that system of structures. And again, I think given the tax rates that exist in the near future, and I'd assume most people going into property aren't going in there for less than a year, it would be really prudent before setting up any new structures just to sit down and go, well, how much am I going to have as an earning capacity, whether it's a business owner or an individual, and working out, well, if there's no real difference in the tax saving, whether it's negatively geared in my name or my partner's name, it might be just as easy just having it in your partner's name, the whole property, and yes, the negative gearing's there, but it's the same tax rate effectively. So, you're not worried about the highest income earner, who then usually goes into the negative gearing strategy potentially, but then has the capital gain in their name when they're still the highest earner. So all of those stress points, which can be mitigated by having an investment trust or family trust, sort of can be managed within the family without the accounting admin costs that come with it. So I think that's where a lot of mum and dad investors who might only have 1 or 2 properties might be perfectly fine without it. But again, depending on their circumstances and their situation, they should sit down and actually have a plan and go in knowing, okay, well, we're saving accounting costs, but we could be up for more tax, or we're going to pay more accounting costs and have control of how the profits or the income from the trust will be used. So I think those are the real sticking points for most people is to sit down and actually talk those things through. And if they have, then, no guarantee the decision's going to be right, Jared, but at least they've made an informed decision, and that's what we want. Yeah. And I think that's the key part. People hate being presented with all the news or opportunities they could have done prior without knowing they said no to it. And I think that's what most people accept. They made a decision and move on from it. So.
And you made a good point about the sort of timeframes to consider different things too, because you've got the situation of the property and their situation at the time that they're purchasing, and then over time that property might become more, the rents are going to keep increasing. It might move more towards the more positive income. Obviously, we're trying to build a passive cash flow over the longer term, and then at some point you may sell the property. So you've got your capital gains tax considerations on the back end and how that might all work. So when we actually go into these different phases, what are some of the potential, tax benefits or advantages of having it in a type of structure if that did suit your overall situation?
Yeah, so I suppose the common thing with a family trust is if it's a loss in the trust, it's quarantined. So it's not going to give you the ability to have.
So if the property's losing money each week, it's stuck in there, isn't it?
It's stuck. So the loss is stuck in there. But we would be advising clients, if it's an investment trust, you should actually have other investments in here, and hopefully you are making money,
generating some income to offset that loss. Yeah,
offset that loss.
And when you say stuck, what does that mean? Like it means, you've got your personal income outside and...
Yep. So if you had your family trust on one side and you have Jared on the other side and you've got your salary and wage, let's say you have a $20,000 loss in that trust, you can't use it. It's stuck in that trust to be used at a future date when you make some money in the trust. But if you don't, it's just stuck in there. There's the negative gearing that people allude to against reducing their income tax in their own name doesn't exist. But you've given that up for the ability to control who will receive the capital gain from your family on the selling of that property. So you've got to make that decision. So the family trust has benefits, but the loss being stuck in there is one of the negatives if you've just solely got negatively geared property in there. And, I would ultimately argue that most people going into property don't want a negatively geared property over the life of the property because tax is one thing, but you want to be making money. Otherwise, you're just really sort of losing the yield year on year, and that's not ideal. Depreciation is probably the one that some people get caught into going, well, a newer property has depreciation, so that provides more of a tax benefit. I just probably want to allude that just be mindful that capital deduction gets added back when you sell the property, so it increases your capital gain at the end. And a lot of people forget that part of the deal.
Of course, if you never sell them, that's not an issue. But come time that it does, that depreciation, it reduces your tax base that it's calculated on, doesn't it?
Exactly. So then you pay the capital gain. It's still a benefit because
it helps you along the way in today's dollars,
and you get a 50% discount on your capital gain in the current rules. So you're still in front, but it's not as big of a carrot as it is, because it does come back at some point. And I think that's what people sometimes forget.
Well, we've seen the changes to depreciation as well a few years back, and the carrot certainly halved, for those that aren't building the whole property themselves. They've sort of taken away what you can claim on fixtures and fittings now if you didn't actually build them.
Yes, which I think was something that was always hard to tackle with, because, as quantitative surveyors working out what the values were. But those are the rules, and who knows what the rules will be, 2 years from now, Jared. But I would hope they would still keep this 50% capital gains discount, because that's probably the biggest incentive for investing. Otherwise, it sort of eludes the benefit for most people to invest, whether it's shares, property, or other assets.
So are there any specific types of structures that are more suitable for property investment? Because you mentioned a few of them to begin with, and maybe we can look at the camps of passive long-term investor and maybe someone that plans to sell, or a developer, because you did touch on those two.
Yeah. So usually for developers, the unit trust is a very common structure, because there's usually multiple parties in a property development. And a unit trust just sort of works on each person who puts money in there has a set unit allotment. So they'll get, let's say you put 5% of the money in to buy the property and to do the development, you're going to get 5% of the actual profit from the finished development at the end of the process. And it's a very clear entitlement, so it's set. When we were talking about family investment trusts, those are discretionary of nature. So basically that driver or the trustee will decide which beneficiaries will receive the money at the end of each financial year. So very different structures, because one's completely up to the driver, while the trustee of the unit trust doesn't decide who gets the unit allotments. It's already set and prescribed in the trust documents. So, and that's why unit trusts are usually used for that, because it's easy to manage the unit allotments.
Yeah, clear cut. You're not going to have what you're getting out of this project changed discretionarily by the trustee because they don't happen to like you on completion.
Exactly, which is, we don't really want that in a property development side of things with unrelated parties. So a unit trust is a really key way. And it also means when there are some costs in the project and there's money to be returned, it can actually be done as a return of capital first, and it allows for a few other things in there. But if you were to go into a property development, there are property development lawyers and accountants that will typically get the right structure for that size development, manage all the GST and other things that would go down the development side of things. So very important to separate all of those things in there. And bigger the development, probably a lot bigger the cost. So we've had been part of clients that have had 50 lot subdivisions and things like that, where it is a very detailed process, because each plot of land has to be valued for the titles and processes around that. So and those developments sometimes aren't very quick. So we've got one that's gone on for about 6.5 years. So it was supposed to be 3 years, Jared, but it's 6.5 at the moment. But we'll work through the process as it goes through. So that's usually where you would see unit trust. I have seen unit trusts for commercial properties where various parties would use a combination of their, if they did have a self-managed super fund or part of their family trust or other unrelated parties that bought into that property for a yield return for the long term. So, but obviously there is, it comes back to the purpose of that investment. And I think you sort of alluded to it. It depends on how long what's the end goal? Is this property supposed to provide the passive income in retirement for you after you stop working? Or is it more, it's a capital growth asset and you're going to offload at different points when the yield doesn't line up with the capital growth, and you're going to exit, pay the tax and invest into another property or another investment product, whatever it is. I think very clear goals and set targets is really important, but those things are allowed to change. Just review it. And I think I always look at the tax consequences. If you're paying a tax bill, it generally means you've done something right. What we want to do is look at how you can potentially reduce it. And there's plenty of easy ways to do that. That could be, if you've got a positive property yield in your own name, you can put more money into super. So you can reduce your positive geared property by putting more money into super to reduce that tax bill that might exist from there. But that's, again, part of that whole investment journey through both your own name, your family trust if you have one, or your super. And I think as long as people are very clear on those goals, then it makes it very easy to have that yearly review on where you're going and how you're tracking with it. So I think people get sometimes a little caught up in the tax side of things, but that 50% discount is a really big incentive if it makes sense to offload a property and find another property or multiple properties that could give you yield or other structures.
And so does that 50% discount also apply to the various trusts if you've held the property for more than a year, as it does for your personal name?
Yeah, so if you've got a family trust and you've had that property for more than a year, the discount is actually determined by who receives the money. So if that money went to an individual, they would be entitled to that 50% discount on that capital gain income, obviously subject to their trustee. And if it's a company beneficiary, so you could park the money in a PTY Ltd company or an investment company, or some people call them bucket companies, that wouldn't get the 50% discount, and it'd have the tax rate of 25 or 30%, depending on the size of that company. So those are all the things to weigh up. But I would say for most people, if you've been holding that asset for more than a year, you're going to find that even in the highest tax rate of 45 plus the 2% Medicare levy coming in next year, 47%, with that 50% discount, that's still going to be lower than the company tax rate. So you're better off just giving the money to an individual, and then you're not tied up with the constraints of the money or the investment being stuck in the bucket company or investment company. It's your money. Choose your next investment plan to go into. So I think that would be the initial thoughts you'd have in a meeting, is to see all those puzzles or all those pieces, put the puzzle together for yourself.
And you mentioned a few drawbacks with losses being trapped in a trust and not claimable against your personal income. Is there any other drawback that come to mind that people should know top level? Yeah,
I suppose other than paying your accountant.
Yes, the fees. Yep.
We do need money to survive, Jared, but we prefer not to have losses that get bigger because we have to keep maintaining trusts. And I think that's probably the biggest cost for most people who've just got an investment trust that is not doing much or has got losses in there. You keep contributing to the accountant or asset to maintain the trustee company. You've got trust minutes to do on a yearly basis. So you've got all these ongoing compliance things because you went down the path of the family trust. And if the only asset in that trust was one property that's negatively geared, the only way to exit it is to sell the property, and you would have the income hopefully on that part if you did it, and just have all these losses that are trapped in a trust. So it is an undertaking to set up a trust, and sometimes people will jump to set up a trust very early on because of something they've heard and haven't understood what they've just committed themselves to. And I think that's where the trap sometimes exists, is
they bought the property, it's in that name, can't easily be changed without stamp duty and realising again according to the ATO. So, big implications if you work it out.
Well, sometimes a simple mum and dad solution, or the single person owning it who's nowhere near the 180,000 total income, it's simple and it's actually going to work very well.
I definitely lean more towards let's try to make everything we do simple all round, because complexity holds people back and confuses them. And, it can be another obstacle to actually growing a portfolio when you create all this complexity around you.
And I suppose the other thing is sometimes from a lending point of view, you've got less opportunities to refinance, depending on, banks' criteria. Sometimes, that
It's a big drawback to consider, and definitely get your finance broker involved and get some input on that at the same time, because
it's the last thing you want to do is,
if you're needing to use secondary lenders, or you only fit in certain banks' boxes, if you're a business owner as well, your lending options might already be more limited than the PAYG borrowers. And then if you start putting complex trusts and other things on that lenders won't lend to, then you can be down to one lender. And then what do you do if you need to refinance, or if you want to move that loan to someone else?
it can be difficult. And also sometimes the banks, I think a family trust is a fairly common structure for most of the lenders, but the issue is sometimes they have a higher rate that may apply because of the structure. But again, each bank has their own T's and C's of what suits them this year and what might suit them next year, and you might be caught in that model. But while a mum and dad or an individual person owning a property is the most flexible way to refinance, because most lenders recognise an individual and are happy to refinance them, opposed to business structures or family trusts or self-managed super funds are a very, very niche space as well if people were to go down that pathway.
And what about land tax, Ash? Because we hadn't mentioned that, and it might not be on most people's mind when they buy their first property, but then over time, if they have quite a number of properties, they all grow in value and they're all in a single state, how does this kind of weave into the considerations?
Yeah, so land tax is the one where the saving could be justified by the setting up of the trust. So with a corporate trustee, because what happens is land tax in the state of WA, for example, would view each entity as a separate structure. So instead of the land tax rate being grouped and amalgamated and paying a bigger sum, you actually paid it on each property's value, opposed to the amalgamated value of all your different WA properties together.
And it's a bit of a sliding scale, isn't it? So the higher the value, the more you pay. It's, taxing the rich landholders that can supposedly afford it. And although many of them are just, asset rich and not cash flow rich. So that's why they often have to come to look at selling a property or working out how they're going to pay these large land tax bills.
Yeah, it is significant, the land tax, and I think a lot of people have this misconception that the land tax rate is actually it's tiered naturally, but it's not. It's actually grouped, so they don't worry that you've got each property. They actually go, Jared's got 5 properties. But if Jared had a family trust for each of or a separate entity for each of his purchases, the saving would be significant, and it would actually maybe potentially just cover just the accounting costs alone by having that structure. But again, still have to have that overall view of how the way of the mix is it negatively geared, is it positive, and all the rest of it around it. So if it's positively geared properties, then it would be almost, I wouldn't say no-brainer, but it'd be very positive to set up separate structures for them. But if they're negatively geared, the loss of just having that quarantine might be too much to save. So
yeah, makes sense. So how does the other factor, which is not in your direct wheelhouse, but you've got some sort of asset protection benefits, and how does those benefits potentially weigh into the considerations too?
Yeah, so from an asset protection point of view, having certain structures basically mean those assets are owned by those entities. For example, your family trust assets are, if the trustee is a company, is viewed separately to the assets of yourself, and in a situation where you might be, touch wood, Jared.
Yes, let's all touch wood when we're talking about that.
If you're litigated or sued, those assets may be left alone because it's a separate entity, not linked to yourself. So those are probably the things in there. But I would argue for most investing purposes, your asset protection requirements are probably low unless you're in a business, and those examples are for business owners alone, is like having your own liability. But for a mum and dad person working, having those assets in a family trust with a trustee does provide some protection. But again, I don't know what things those people are doing that are putting them at risk of losing their assets. And I think that's where ultimately it comes back to all insurances. Obviously, insurance is really important to mitigate risk, but then looking at the overall picture, what are the likeliness of that, and what's the cost benefit of setting that up or having that protection? And for some people, there are reasons or purposes that they've had in their experiences to justify setting up the separate trust just on asset protection alone. For some people, it's like, well, I'm just a real retail person. I don't understand why I need the asset protection, and I would probably hinder on the side of it. You need a strong case for an employee in a very safe job to why you would need asset protection for as a justification of the family trust. If it's a bonus, great. But if this is a driving force, I would probably question the need.
Well, hopefully we haven't hurt people's heads too much today. But if anything, I hope people take away that, it is a very personalised decision and situation that needs to be assessed. And that's why it's important to have an expert that can actually take you through it. And, you don't try and work these things out yourself on Google, just like you don't get your own dentistry or fillings done. You don't try and do them yourself. So what would people say as a starting point if they did want to reach out to you and see how you might be able to help? I'll put your details in the show notes, of course. And how do you what's your process normally to see?
So the normal process is usually I was previously to a discovery session to understand the purpose and the drive and and what the end goal is, because that's the best way to have that conversation, because you've gone, well, this is what we'll do in year 1, year 5, year 10. If all of that makes sense and everyone knows that, you sort of know what the journey you're going to go down. If they're not very clear on year 1 and year 5, we usually would advise people to go back and actually rethink the whole purpose. Obviously, get around a financial advisor if they've got a buyer's agent, if they've got all of those things, and just clarify what is the purpose, because everyone then is on the right page of why you're doing it and what you're looking for. Because even from a buyer's agent point of view, they're going to be looking, well, are you after yield? Are you after growth? What is the underlying purpose of this investment? Because then it guides people in the right direction, because it makes it very easy for us to find the right structure. Because, I've seen an example of a client that, bought a unit in an apartment complex, great yield return, capital growth was not part of the overall plan, but is in the wrong structure, because that should have been in a lower tax structure, because the capital growth is never going to be significant. It's positively geared. It should be in a low tax person, which would be his spouse, opposed to in his name. And it was just a simple, the person's advice was, it's going to be negatively geared, we'll put it in your name. And turned out, no, he knew what he was doing. It was a yield investment return. So he got a great property returning 8%, and you've got a tax problem in the highest person's tax rate, which hopefully might not be a problem in a year's time. But
at least the changes to the tax rates will smooth a bit of that out for people, and make the choice of individual name a little bit more tilted that way. So which makes it easier for everyone, I think, and is great. If the tax system is to be simpler, there's less need for structures and purposes, and ultimately people get a better outcome, and it's easy to manage. And of course, just because you're not going to set up a crazy structure doesn't mean that you don't need a good accountant on your team, and to maximize your deductions and give you the right advice as well. So I'm sure people can get you help with that too. And there's certainly a big difference between going down to your local H&R block and actually getting an expert that understands property and the whole picture on their side. So definitely worth getting in touch with you if you're a property investor or business owner in either camp. So
thanks a lot, Jad. I really appreciate any of the viewers reaching out, and I'll try and help them on their journey.
Thanks, Ash. We might get you back again to chat super.
All right, that sounds good.
Everyone keeps asking me about this, but we haven't touched on it. So
okay, I'll look forward to it.
Thanks, mate. See ya.
Cheers.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.